There is a quiet financial war happening right now, and most people don't even realize they're losing it. Every week, your paycheck arrives, your bills take their share, and somehow, no matter how hard you try, the future still feels just as far away as it did the month before. That's not a coincidence. That's not a personal failure. That is the system working exactly as it was designed, pulling money away from you faster than time can replace it. But here's what nobody tells you. That same force called time, the one working against your paycheck, can be completely reversed. And it only takes $70 a week to start turning it around. In this video, I will show you and Bobby 5 exceptional ETFs that can change the game for you. I will walk you through what makes these ETFs unique and demonstrate how a $70 weekly investment into these ETFs can deliver over $750,000 while also generating over $7,000 in monthly dividend income. If your goal ultimately is financial freedom, this is the video you don't want to miss. Welcome to Investments Mindset, where wealth builders come to get inspired. Before we continue, please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Let's dive in. Firstly, let's talk about the $70 a week investment. If careful thought is not applied, it will sound like a lot of money. But the truth is, we are talking about an amount that's less than most people spend on takeout every single day. It's a few streaming subscriptions or a couple of impulse buys you forget about within a couple of days. But when that same $70 gets invested consistently, week after week, something extraordinary begins to happen underneath the surface. It doesn't look dramatic at first, and that's the part that trips people up. The early stage of building wealth feels almost insultingly quiet, and that silence is what causes most people to quit before the real magic begins. Here's what makes weekly investing so emotionally powerful in a world that feels financially unpredictable. You don't have to be right about anything. You don't need to know where inflation is headed, when the next correction is coming, or which sector is about to outperform. When prices rise, your $70 still goes in. When prices fall, your $70 buys more shares at a discount. When the market recovers, you automatically benefit from those cheaper purchases. In a world full of financial chaos and noise, weekly investing is one of the only habits that actually works in any condition. It doesn't require brilliance, it requires showing up. Now, choosing where to put that $70 is where intentionality matters. The best long-term investments share a specific set of qualities, and understanding them helps you stop chasing hot tips and start building something durable. Let's check them out. First, why diversification is critical. Owning hundreds or thousands of companies at once means no single failure can derail your progress. One company imploding doesn't shake you because you're not dependent on any one outcome. Broad exposure across different company sizes, sectors, and styles means your portfolio stays balanced regardless of which area of the market is leading that year. Also, paying attention to real historical performance backed by companies that have grown their earnings over decades provides the kind of foundation that doesn't crumble in a single downturn. Next, dividend growth matters because when companies raise their payouts year after year, those increasing dividends buy more shares automatically, making the compounding loop faster and stronger with each passing year. And low fees is super important more than most people realize because even a small fee, compounded over 30 years, quietly steals a stunning amount of your returns. Keeping fees near zero means nearly every dollar stays in the machine working for you. When you build a portfolio around those qualities using low-cost Fidelity Index Funds designed for long-term growth, you're not gambling, you're not speculating, you're building a compounding engine that runs quietly in the background while you live your life. Now, this is the part where everything gets real, because understanding the mindset and the math is one thing, but knowing exactly where to put your $70 every week is what turns a good idea into a life-changing habit. These 5 Fidelity funds are not random picks. Each one was chosen because it meets every quality that long-term wealth building demands, and together they form a portfolio that works in good markets and survives the bad ones. I narrowed the list to only the strongest performers built for both income and growth. Most importantly, I focused on funds with positive price returns, meaning no NAV erosion, so your capital stays intact while your income compounds over time. Now, let's dive into these unique ETFs. Coming up at number 1 is the Fidelity Blue Chip Growth ETF, ticker symbol FBCG. This is the engine of the portfolio, an actively managed fund that invests in large and mid-cap blue-chip companies with above-average growth potential and sustainable business models. These are the well-known, well-established, well-capitalized giants that have proven they can grow earnings through recessions, rate cycles, and economic chaos. What makes FBCG genuinely exciting is that Fidelity's managers aren't just tracking an index, they're identifying companies they believe the market has mispriced, hunting for growth before everyone else catches on. That active edge shows up in the numbers. FBCG carries a 0.05% dividend yield, a powerful 20.11% 5-year dividend growth rate, and has delivered an outstanding 13.7% average annual price appreciation over 5 years, with a since-inception return closer to 19.8% annually. FBCG lays the foundation for this portfolio by targeting the companies most likely to lead the next decade of market growth. The next unique ETF on our list is the Fidelity Midcap Index Fund, ticker symbol FSMDX. If FBCG is the engine, FSMDX is the accelerator. This fund targets mid-size companies, businesses that are no longer fragile startups but haven't yet been fully priced for the growth still ahead of them. It holds roughly 300 companies spread across technology, industrials, consumer goods, and finance companies in their expansion phase, still hungry to climb. The performance reflects exactly that energy, with a 2.42% yield, a blazing 17.21% dividend growth rate, and 7.4% annual price appreciation. Every dollar you put into FSMDX is a bet on businesses that are still becoming something bigger, and history shows those bets tend to pay off in a major way over time. Securing the third position on our list is the Fidelity US Sustainability Index Fund, ticker symbol FITLX. This unique ETF gives the portfolio something that most people overlook until it's too late to get in early. This fund screens for companies with strong environmental, social, and governance practices, and what that process actually captures is a concentration of forward-thinking leaders in tech, healthcare, and communications, the sectors shaping the next 30 years of human life. The companies that treat their employees well, manage their risks intelligently, and build sustainable operations tend to be the ones still standing when everything else gets shaken out. FITLX proves this, with a 1.14% yield, a 13.74% dividend growth rate, and an impressive 13.06% annual price appreciation. This fund adds long-term resilience while keeping your money pointed at the future. Before we continue, if you find value in this video, even just a little, please subscribe and hit the like button to help us continue to provide more insightful and educational videos. Your support is highly appreciated. Thank you. Coming in at the fourth spot is the Fidelity Growth and Income Portfolio, ticker symbol FGRIX. This exceptional ETF is the emotional anchor of the portfolio. When markets get frightening and headlines make you want to run, this fund is what keeps you steady. It concentrates on high-quality large-cap companies with stable earnings and a track record of dependable dividends, the kind of businesses that paid their investors through every crisis of the last century and kept growing anyway. But FGRIX doesn't just offer comfort, it delivers results. It carries a 3.13% yield, a remarkable 19.68% dividend growth rate, and 8.17% annual price appreciation. It lifts your income and your growth at the same time, and that dual contribution becomes increasingly powerful as dividends compound year after year. And now, in the fifth spot, is the Fidelity Dividend Growth Fund, ticker symbol FDGFX. This ETF acts as the portfolio's income stabilizer and compounding multiplier. This fund zeroes in on companies with long-proven histories of raising dividends and rock-solid financial fundamentals. It doesn't swing for the fences. Instead, it does something arguably more valuable. It quietly strengthens the dividend income the entire portfolio generates year after year without flinching. FDGFX yields 3.2%, grows its dividends at an extraordinary 18.03% annually, and delivers 2.78% annual price appreciation. Its purpose is not speed. Its purpose is to ensure every other fund in the portfolio has a steady income engine running alongside it. Now, here is where the numbers become something you can feel. Calculating the portfolio's average dividend yield starts with listing each fund. FBCG at 0.05%, FSMDX at 2.42%, FITLX at 1.14%, FGRIX at 3.13%, and FDGFX at 3.20%. Add those together and you get 9.94. Divide by 5 for the equal weighted average, and you arrive at a portfolio dividend yield of 1.99%. Using the same simple approach across the other metrics, this portfolio delivers an average dividend growth rate of 17.75% and an average annual share price appreciation of 9.02%. Now, let's walk through every step of this projection together so you can see exactly what Bobby's $70 a week is building underneath the surface. Step 1. Establish the annual contribution. The first step is to convert the weekly habit into an annual figure. Bobby invests $70 every single week without fail. Multiply $70 by 52 weeks in a year, and you get an annual contribution of $3,640. That's it. That's the input. Just $3,640 per year flowing steadily into a 5-fund portfolio. Step 2. Calculate the total annual return rate with DRIP. This is where reinvestment changes the entire story. On its own, this portfolio delivers an average annual share price appreciation of 9.02%. But Bobby isn't pocketing his dividends. Every dividend paid by each of these 5 funds is automatically reinvested through DRIP, buying more shares that grow in value and generate even more dividends. That dividend yield starts at 1.99% per year. When you add the price appreciation of 9.02% to the dividend yield of 1.99% being fully reinvested, the total annual return powering this portfolio is 11.01%. That 11.01% is the rate at which Bobby's money compounds every single year he stays consistent. Step 3. Apply the future value formula. To calculate what this portfolio will be at each milestone, we use the future value of an annuity formula, the standard tool for projecting how regular, consistent contributions grow over time with compounding. In this formula, PMT represents the annual payment of $3,640, R represents the total annual return rate of 11.01%, written as 0.1101, and N represents the number of years. Each piece of this formula has a job. PMT is Bobby showing up every week. The rate is compounding, doing the heavy lifting. And N is the most powerful variable of all, because the longer it runs, the more breathtaking the result. Step 4. Calculate portfolio value at each milestone. At the 10-year mark, we raise 1.1101 to the power of 10, which gives us 2.8427. Subtract 1, and you get 1.8427. Divide that by 0.1101, and you get 16.74. Multiply by the annual contribution of $3,640, and Bobby's portfolio value reaches approximately $60,900. By this point, he has personally contributed just $36,400 over 10 years. The portfolio has generated over $24,500 in growth that he never deposited. The snowball is real, and it is rolling. At the 20-year mark, we raise 1.1101 to the power of 20 and apply the same methodology as in year 10 to arrive at a portfolio value of approximately $234,100. Bobby has personally contributed $72,800 over 2 decades, but his portfolio is now worth more than 3 times that amount. The $161,300 difference is not luck, not a raise, not a windfall. It is compounding, and it has been quietly running the entire time. At the 30-year mark, we raise 1.1101 to the power of 30 and apply the same methodology to reach a portfolio value of approximately $726,500. Bobby has put in $109,200 of his own money over 30 years. The portfolio has generated over $617,000 in growth above and beyond what he contributed. That means for every dollar Bobby invested, the market and compounding returned more than $6 additional on top. This is the number that makes people emotional, because it proves that the size of the habit was never the point. Time was always the point. Step 5. Calculate the annual dividend income at each milestone. Here is where the story becomes something truly powerful. Because this isn't just a portfolio that appreciates in value, it's a portfolio that pays Bobby increasing income for the rest of his life. To understand how that income grows, we need to recognize that dividends across these 5 funds grow at an average rate of 17.75% per year, while share prices appreciate at 9.02% per year. That gap means the effective dividend yield on Bobby's portfolio increases every single year. The annual yield growth factor is calculated by dividing 1.1775 by 1.1101, yielding 1.0607, indicating that the portfolio's dividend yield increases by approximately 6.07% per year beyond what price growth alone would suggest. Based on this data, at the year 10 mark, Bobby's portfolio would generate approximately $2,187 per year in dividend income, roughly $182 per month. A year ago, that felt impossible from a $70 a week habit. At the year 20 mark, his annual dividend income would climb to approximately $15,146 per year. That's over $1,262 every single month. Remember, Bobby didn't change anything. He didn't increase his contribution. He simply stayed consistent and let 2 decades of compounding do exactly what it promised. Now check this out. At year 30, his annual dividend income would explode to approximately $84,853 per year, which is over $7,071 every single month. Think about that for a second. $7,071 every single month from $70 a week. This is from a habit so small that most people would talk themselves out of it. But because you're here watching this video, I believe that won't be you. So take that bold step today. If you're serious about building real wealth, then consider this channel your financial gym. Every video is a workout for your portfolio, your mindset, and your money skills. If today's video helped you level up your financial education, even just a little, please smash that like button and subscribe so we can continue to grow and build wealth the smart way. Please note that we are not financial advisors. The content on this channel is for educational and informational purposes only. It is not intended to provide investment advice or recommendations regarding specific securities or investments. Always conduct your own research or consult a qualified financial professional before making any investment decision. Every investment involves risk. Click on the next video on your screen. Thank you, my friend.